Welcome to our Entrepreneurs Breakfast, the first one of 2022. For those of you who I haven't met, my name is Gary Watkins, and I'll be doing the presentation today. Today's presentation is a little bit about entrepreneurship, a little bit about business, but more importantly, it's just the fundamentals of business. Most people in business have a skill. They're either there because of their skill or because of luck, but not necessarily all people in business are the most intelligent people in the room. So we often find entrepreneurs actually lack business skills and they need to employ people to assist them to make their businesses successful. So we're going to be going through a couple of fundamentals in business that are very important to understand and nail down. We're a small group, which is fantastic. So we're going to keep it very casual. If there are any questions during the presentation, please ask. Or if you'd like to wait till the end, you're most welcome to do so. And we'll have a little bit of a Q&A straight afterwards. If there's anything I don't mention here that you've got on your mind, you're also welcome to ask questions about that. Okay. So before we start, thank you. Just have to check everything works. You want to just check that everything works? Okay. Nothing's working. So before we start, our technician, I'm going to just quickly show you a little video about Quattro. Quattro is not a business, it's a group of businesses. We know this as the Quattro Finance Group. We have multiple companies, each one of the companies representing a different aspect of financial services. We have everything from legal to wills, to financial strategy, to investments, international stockbroking, accounting and BI, anonymous reporting, and the like. So if we'll quickly have a little video clip, you can have a look and see, and then I'll go through each one of the entities, and then we'll progress for today's meeting. All right, so that's just a little quick overview of the group in terms of each business. Each one of these businesses is headed up by a specialist and their team. And I think what's very, very crucial to understand is that we are highly focused, highly motivated, and highly specialized in each one of these areas. We are not a jack of all trades, master of none, and you cannot ever compare us to the corner broker, Piet Boegenpoel and Associates. There's not one other financial services group in the country that offers the spectrum of advice and services that we offer. Getting on to what we're going to be discussing. Firstly, our advice philosophy. I think what's incredibly important is that it is uniquely yours. Every single one of you have got a different need, be it personal, be it your business, be it an investment, be it a strategy, whatever it might be. We tailor-make the solution to suit your specific needs. Personal engagement is crucial. We want to have a deep understanding of you, your family, your children, your dynamic, your industry, your organization, your employees, to make sure that we understand your real needs. I always assimilate our industry to the likes of a doctor. I have a doctor. If someone said to me today, how did I choose him to be my doctor? I can't really remember, but I think it was probably my mom or dad who booked me a doctor's appointment. And I went to the doctor. I trust that doctor, and I will share all my feelings with the doctor in terms of if I'm feeling sick or stomachs or heads or whatever. I trust him to examine me, and I trust that the prescription that he gives me is going to help me with my problem. Financial services is exactly the same. Financial services, you're not buying product, you're buying people. I never went to my doctor and said, I'd like to see your credentials, and then went to another doctor to see their credentials, and did 5 different interviews with 5 different doctors, and then got their pricing on each doctor, and then made an analysis as to how I would choose my doctor. I chose my doctor because I trust him. And when choosing a financial services partner, you need trust. There needs to be trust that we trust our clients is giving us all the information that we need to help them make an informed decision with the correct advice. And you need to trust us that you can give us the information without worrying about anything, giving us the freedom to be able to take that information so we can consolidate it and put it into something and design a strategy specifically for you. We embrace technology, obviously, and we are financial strategists. We collect all your information and we design a plan that suits you, kind of like an architect designs a house. We design your plan that suits you, taking into account your business and your personal plan. But when I say architects, I didn't say that we are the builders. The builders, they bring the bricks. And the builders in our industry would be the insurer. Whether we use clay bricks, concrete bricks, we don't really care what bricks we use. What we care about is that the design is what you need. And that's what we are. We are financial strategists. We design strategy for you. And then afterwards, at the end, with the information that we've gathered, we're able to give you a concise report where you can make informed decisions, not decisions based on emotion and not decisions that are based irrationally, but informed, calculated decisions. What we're going to be discussing today is around business protection plans, products that you can use, things to look out for, and then the implementation of the correct structure. The entrepreneur's topic is massive. We will never cover everything. This is just really an insight into what we do. But if you've got trusts that own companies, or you've got other partners that are involved in your business, and that partner is not a natural person, in other words, another company owns shares of your company. We're not going to be discussing that today, but we can do that afterwards if you want to, or we can do it one-on-one. But it's just to give you some sort of overview as to what you can be looking at. So this is basically how we do our recruitment process. You start right at the top. When you join Quattro and you would like to get a job with us, if you're an engineer, so if you're a problem solver and you've got math skills, you'd be an engineer. If you've got problem-solving skills and people skills, we'd take you into management. If you've got people skills and a drinking problem, you go into our sales division. If you're drinking and you're heartless, you become the lawyer. And then the heartless people with OCD, we put into HR. And then our accountants are OCDs with math skills. So that's kind of like how we've built our business. So when we invite you to the next wine tasting, just know you're going with a whole lot of biscuits. Okay. All right. So firstly, I think to start with, most people in the room have been sold insurance policies over time by a broker. We call them policy peddlers. We don't actually like them. But basically what they do is they don't understand business at all, and they don't understand strategy. So what they do is they leave matric, they get a job, and they start to sell policies. The problem is that financial planning is not about insurance. Financial planning is about you creating your own wealth over time. And if your wealth is not enough to support your needs, you use insurance to top up the shortfall. And I'll give you a quick example of what I'm speaking about. Let's say on my death, I'm just going to use this as an example. My wife's name's Jackie, by the way. So on my death, Jackie needs 40,000 Rand a month to pay for 2 children to go to Kearsney College, just as an example, 40,000. She would need roughly 10 million Rand invested, growing at 12% a year, to allow her to draw 40 grand a month, every month, and every year increase that by 7% to keep up with inflation. It's just a rough thumbstick. Okay, it's 40 grand a month infinitum, so it would last her until she died. 40 grand a month, every month, increasing at 7% a year, she need about 10 bob. If I've got 4 million of my own already saved up in some way or form when I die, that's available, the shortfall is only 6. So then she would take insurance on my life for 6 million. When my wealth grows from 4 million to 5 million, we would reduce the policy from 6 to 5. And when it grows to 8 million, I'd reduce my policy to 2. And when I've got 10 million of my own, I don't need insurance anymore. So to use the exaggeration of it, Bill Gates doesn't need life cover for his wife. I'm pretty sure there's enough cash there to support all of our families forever. So whilst you're growing your wealth, all we're doing is we're topping up the shortfall. And it's so important for you to understand that philosophy when you're in business, because business is potentially an asset of yours. And if you can realize that asset on your death, make it into cash, it will then mean that is the foundation of your financial plan. We know when you die, you're getting X amount of money for the sale of your business. We now know what the shortfall is, and we can top it up with personal cover. And if you don't strategize like that, you'll be paying for insurance policies for the rest of your life. And you'll end up like the rest of South Africa, where only 3.5% of our population will actually retire. So our philosophy is this: protecting what you've built up for yourself, covering the shortfall, and then reviewing on a regular basis to make sure you never spend 1 cent too much on insurance, but you never under what you need. Okay, so that's really our job. So business and personal financial planning are interlinked. They are inseparable. If you don't own a business and you're just an employee, then you'd have personal insurance cover and potentially a pension funded work. We would work with that. All right. The trick, though, is how do we mobilize the business? If you own a business, how does it become cash? So the first things we started is to say, we were chatting earlier. In fact, I was chatting to 2 guys in the corner there. During COVID, they started a new business. Okay. Now, the first thing you do when you start a business is you want to get the rules of engagement sorted out. So as an example, I'm a heathen and I decide I'm becoming a Christian. If I become a Christian, I've got to now understand the Bible, because in the Bible, there's 10 commandments. Okay. Thou shalt not love thy neighbor too much. Okay. So those 10 commandments are the rules of the Bible, as an example. In business, you have what they call a memorandum of incorporation, which is a statutory document which talks about the rules of your business, the foundation of your business. How's this business formed? Okay, so MOI, or Memorandum of Incorporation. It's a statutory document. If you start a company today, you will have one. You'll either have a vanilla one, which is just like the carbon copy, literally, of the Companies Act, Or you'll have a tailor-made one where you've actually sat down with someone who's competent, who's understood your business model, the partners, the funding, whatever it might be, and they have amended an MOI and drafted you a unique one. The next agreement you have is what we call a shareholders agreement. This agreement is very, very important. The shareholders agreement deals with private matters that you don't want in the public eye. So just to give you an example, I can go right now without your permission, and I can go and get a copy of your MOI immediately, right now. Okay? It's a public document. So you don't want how you value your business in the MOI, how you exit your business in the MOI, how you resolve disputes in the MOI. Because all of a sudden, your competitors have got access to a lot of stuff that you might not want them to know about. Particularly if you're wanting to sell your business one day, they can see what your valuation method is that you've applied, and they've got a starting point. So any private matters, personal matters, are omitted from the MOI, and they are contemplated in the shareholders agreement. And that's a private document that you keep in your drawer until something arises where you need to now have resolution. You'll now pull out the rules of engagement and go, all right, so you stole money, what do we need to do? Or our business that we started needs R1 million worth of funding from the shareholders, and the one shareholder says, I can't pay. I haven't got enough money to pay. So now you're sitting in a situation where you, as a business, need to go forward. You need to spend this million. You're 50-50 with your partner, and your partner's saying, sorry, I'm broke, I'm not paying. So what do? Is it fair that you take R1 million of your money and stick it into the business, and your partner just comes along for a free ride? If you believe it's fair, well, then that's great. If you don't believe it's fair, how do we deal with it? That gets dealt with in the shareholders agreement. We draft that for you. Make sure that it's done correctly. And I have personally been involved in exactly that situation where my shareholders have said, we can't afford to pay anymore. What do? There's a way that you can address it. Then the last one at the top of the pile is called the buy and sell agreement. Please note, guys, I've not spoken about insurance. This is about company statutory structure. It's the starting point. Most entrepreneurs we see, they have an idea, they form a company, they've got a vanilla MOI, and they charge off into the sunset to try and make heaps of money. And they get so busy in their business, they never address this until there is fuck and be done. Now they sit scratching their heads and they've got nothing and no foundation to fall back on to find out how to resolve these issues. Buy and sell is talking specifically around how you dispose or deal with the shares that you own when you die. The reality check for us is we all are going to die. If you didn't know that today, I'm telling you, you've learned something new. Okay, we're all going to die. If you don't die, we've got another product for you, which is a retirement plan, but it's going to be very, 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 very expensive because we're going to need to provide income for a very, very long time. Okay, so dying is probably the cheaper option. Okay, also, most men die earlier than women because they want to. Okay, as you know. So buy and sell, when you die, what are we going to do with these shares? I just want to explain maybe how the process works. I own a company with Dane and we make orange juice. The company is worth R1 million. When I die, there's a person called an executor, the guy who deals with my estate. Okay? He deals with my will. He's got to sort all the stuff out. He basically steps into my shoes. He becomes me. Okay, even though I'm dead, poor bastard becomes me. Okay, so now he's standing there and he's got my shares that he owns. Well, that I owned 50% of these shares in this estate, and he's got to deal with them. He's either got to bequeath them to my wife, if my will says so, or he's got to sell them to a third party, or he's got to sell them to my business partner, Dane. But he has to deal with them. He can't just go, this is too complicated. Let's not worry about that. Let's just do the other stuff. He's got to deal with everything. The same applies if you get disabled. If you get disabled, by definition of disability, it's the inability to perform your occupation. Some people think disability is, I'm in a wheelchair, so I'll just work from home. No, you can't work from home. You're disabled. If you could work from home, you wouldn't be disabled. You would just be paralyzed. Okay? There's a difference between disability and impairment. Okay, so disability is the inability to do your job. So you are what we would deem to be the living dead. Okay, you're as good as dead. A curator gets appointed. Somebody who administers your estate, who steps into your shoes as though you were dead. They have got to deal with these shares. What are we doing with these shares? Are we going to run this company on behalf of that shareholder? Does your partner want a new business partner? Does he want you to still be involved? Remember, most business partners are partners because they add value to each other. They have different skills. Okay, I am very good at marketing. The other guy is very good at administration. The other guy is very good at implementation. So we've got three partners that have got three unique skills, and none of them have got the same skill. So they could go into business together. I wouldn't go into business with someone like me. Because if I went to business with someone like me, we'd have a great idea. We'd start the business and then it would end. Because I hate admin. I need the administration side of it, and I need the implementation side of it. So you don't want to be in partnership with someone who's got exactly the same skill as you. You may as well just do it on your own. So buy and sell, how do we deal with it when you get disabled? You need to sell those shares, get the money, put it into your estate, okay, which forms the foundation of your financial plan. And then you know what your shortfall is, if there is one, and you top it up with personal insurance. Okay, so those are three documents. There are three separate documents. Okay, we never, ever, ever put buy and sell into the shareholder agreement either. The reason being is the shareholder agreement is literally the Christian Bible or the Quran. It's thou shalt not steal, I will murder you. Okay, that's what the shareholder agreement deals with. The buy and sell deals only with two things: death and disability. That's it. In your shareholder agreements, what we will contemplate, which we'll talk about just now, is how you exit at retirement. One thing which we always say to business owners is this: when you start your business, in fact, I want to ask you this. When you start your business, what's the first thing you should consider when starting a business? Anyone know? Anyone brave enough? Come on. Retirement, exit. The first thing you consider when you start your business is, how do I get out? It's the same as when you get married and you have your anti-nuptial contract. Okay? The first thing you consider when you get married is, how do we get divorced? Okay? You have to start there. All right, so here's some protection plans. We're not going to do these today. We'll do some of them. Buy and sell, contingent liability, P-man, staff retention, exit strategy. All very important components of a business, but unfortunately, due to time constraints, unless you are available after 2, we won't finish. So let's talk about continuity planning, which is the buy and sell. So it's an agreement that is separate from your shareholders agreement and your MOI. I need to also tell you that if the buy and sell agreement, if death and disability is contemplated in the MOI and in the shareholders agreement and on a separate agreement, a buy and sell, your buy and sell agreement will be invalid. The memorandum of incorporation takes precedence over all other agreements, then your shareholder agreement, and then your buy and sell. So you never contemplate the same thing in more than one document ever. So we remove death and disability out of the MOI and the shareholder agreement. It's only dealt with in the buy and sell agreement. And the reason you do that is that your buy and sell agreement is reviewed every year. You might get new business partners. You might have the same business partners, but a change in shareholding. Because maybe Dane didn't have the money to fund the business, so the company issued more shares when I lent it R1 million, and I've become a bigger shareholder now of your business. the buy and sell has to change. So we call the buy and sell agreement a living document. The shareholder agreement is not a living document. It's designed to be there to set the ground rules so that when money flows, agendas don't get readdressed and changed. It's fair from the outset. All right, so buy and sell. Firstly, it compels the deceased estate to sell and the remaining shareholders to buy. So George and I have a business together. In the business, we have a memorandum of incorporation and a shareholders agreement. And in those agreements, they've mentioned preemptive rights. Have any of you heard of that term, preemptive rights, before? Okay. For those of you who haven't, I'm just going to quickly explain it in layman's terms. Preemptive rights means if I want to sell the shares in my business, I have to offer them to George first because he's my business partner, and he has got a preemptive right to exercise the option to purchase the share. It's a protection mechanism for George, because if I had the ability to sell the share to someone else other than George, would mean that there's no preemptive right. I could go and sell them to Dane, and he might hate Dane. Or Dane might be exactly the same as George and add no value. Or Dane could be his competitor who's 10 times the size and has now got George's IP. Or 10 times smaller and has now got George's IP. Access to all the shareholder agreements, access to all the financials, access to all the clients and databases. So preemptive rights is very, very, very important to understand if you've got it in your business. Your memorandum of incorporation, the first agreement I spoke about, it mentions preemptive rights, but those preemptive rights only apply if there are new shares that have been issued by the company, not the shares that are already in issue. So a lot of guys think they've got preemptive rights, but when you actually read their memorandum, they've got no preemptive rights. It's only if the company issues new shares that those new shares, the shareholders have got preemptive rights to get, but not for the shares in issue. So 90% of MORs are, in fact, very dangerous. They're wrong. They need to be amended. Okay. So what this preemptive right now is George has got the option to buy my share, but he's not compelled. It's an option. Preemptive rights is an option. So George could turn around to Jackie, my wife, and say, Jackie, you know what? I don't want to buy the shares. Now, Jackie is sitting going, but hold the boat. Gary told me this business is worth 3 million rand, and I was going to get 1.5 for it, and then the insurance was going to cover the difference. But now he's not buying. I've got a problem here. I don't know what to do. So she goes back to George and says, George, well, what are you prepared to pay? And he says, well, you know, Gary was like, he was the business. You know, I know nothing. So because he's dead, the company's worth nothing. So I'm going to give you 100 grand. And she goes, 100 grand, are you mad? That business makes a fortune. And George goes, well, I'm not prepared to pay any more. So now Jackie goes, oh, God, okay. Goes back to the executor and says, Mr. Executor, George won't pay the 1.5 million rand. He's offered me 100,000 rand. The executor says, right, let's put these shares on the market then. We've got to sell them to a third party. So they put them on the market, and a third-party buyer comes along, Dane. And Dane says, I'll buy the shares. I don't have 1.5 million, but I've got 750,000. Jackie goes, thank you, Jesus. Hallelujah. At least I've got half price. Okay? Goes back to George. Because he's got preemptive rights. George, you've got an offer of 750,000. Will you take it? George says, no, still 100,000. Dane comes to the first meeting with George. George acts like an absolute poople at the meeting. Dane puts his tail between his legs and runs away. Phones the executor and Jackie and says, guys, listen, that O is flipping dookie. I'm not going to go to business with him. I'm out. Suddenly, Jackie is left with the executor with a share of the company she physically cannot sell other than to George, who's sitting with a trump card. He buys it for 100 grand, exercises the option, and he's got a 3 million rand business that's stolen from the family. We can't let that happen. So we put a buy and sell in place that says that the estate is compelled to sell the shares, and the buyer, George, is compelled to buy them. We're taking the option of purchase and throwing it in the bin. Now we guaranteed that the business is going to get sold. Okay. It gives the valuation method and payment plan. Incredibly important. Jackie needs to know when I die, she's going to get how much and when. Is George going to pay 1,000 Rand a month? Is he going to pay 100 grand a month? Is he going to pay 1.5 million in cash? Within what time period? Is he going to insure my life and use the insurance to buy me out? How's this happening? So that's incredibly important. Insurance is the most cost-effective way of providing the payment. We're not selling insurance. We're selling a solution. So I'm going to exaggerate the point, but just to give you an example. If my shares were worth 10 million Rand and George had to buy my shares with cash, he would need to earn, remember he's buying the shares, he would need to earn a salary in excess of 16 million Rand, pay SARS 6 million Rand in income tax to net 10 million to pay to my wife. So his acquisition cost of the business is actually 16 million Rand worth of earnings in order to pay my wife 10 million bucks. Okay? It actually makes a great environment for George to behave badly. It disincentivizes him to actually help. Who in this room would love to work for the rest of their life to earn 16.5 million Rand additional money over and above what you need for your life to buy my shares for 10 bob? No. By the time you've paid off the last installment, you'll probably be wanting to sell them because you're retiring or you're close to death or you've worked yourself to death. It's nonsensical. If George went and borrowed 10 million from the bank over 10 years, it would cost him probably 280 grand a month to repay. 280,000 Rand a month. It's nonsensical. If he bonded his house for 10 million Rand, it's going to cost him 90 grand a month, every single month, for 20 years. 90 grand a month. But for 1,500 Rand a month, you can take life cover for 10 million Rand. That guarantees 10 million tax-free when I die. So I'm not selling insurance, but God, it is the cheapest way to pay this off. It's the most practical solution. It's the most affordable solution, and it's guaranteed. All right. Big thing, premiums must be paid by partners. I must pay George's premium because I'm buying the shares. George must pay my premium. If we cross premiums somehow, if I can't take my personal insurance policy today and say to George, yeah, just take it over, because I've paid that premium on my life. If I've paid 1 cent of that policy's premium on my life ever, that policy will be what they call deemed property in my state and will be subject to a state duty without an exemption. In layman's terms, when George gets the 10 million Rand, my family are going to have to pay 2 million Rand in a state duty for the benefit of his policy. Okay, so it triggers a state duty. But if George pays the premium on my life and I pay on his, no estate duty implication. There are people that are in business, when we meet with them, they say to us, we don't need to see you, don't worry, our buy and sell is sorted. I can tell you this for free. I have never, in 24 years of being in financial services, seen everybody's stuff done perfectly. Not one, ever. Bearing in mind, we consult with 30 to 40 businesses a week. It's frightening. The reason why? Very simple. There's not one financial services group that does what we do. Your lawyer does one thing in isolation. Your accountant does his thing in isolation. And your broker does another thing in isolation. The three never sit down and talk. And that's what differentiates us from every single other competitor. We have got all of those expertise in-house. And we sit with the client and make sure every single I is dotted and every single T is crossed. And then you follow it the wrong way around. That's why I'm forced. I'm dyslexic. I zigzag, I don't zigzag. So, very, very important. Lawyers in most cases, are so protective over their space. They don't want other people to get involved because they're the professional. The accountant, so protective over their space because they're the professional. And there's actually almost a feeling of threat when questioned and asked. We either work with your team, your lawyer and your accountant, or we bring it in-house and we will draft the architecture and then give it to your lawyer and accountant to deploy. But we've got to make sure it's done properly from the outset. So things to look out for. Estate duty I've explained to you. Just to understand, when I went off track slightly, which I do, when your buy and sell is done, and we consult with clients, a lot of people say we've got our buy and sell it sorted. What we find is that they don't. What they've got is they've got a policy in place on each other's lives, but there's no buy and sell agreement in place. It's just a policy. Now, to understand that, just as an example, Dave and myself are in business together. He's insured my life and he's paying the premium. I've insured his life and I'm paying premiums. So the policy structure is perfect, but there's no buy and sell agreement. 10 million on his life, 10 million on my life. He dies tomorrow. His wife says, hey, I'm so glad I'm going to get 10 baht. I'm so sorry that Dave ate that soup that I made him last night. But he told me how much the company was worth. And I'm off to Miami. Let's do this deal. And I go, what deal? She says, no, the policies. You know, the one that you own on his life, the 10 million. And I go, yeah. No, the policy was mine. She says, what do you mean? No. Well, we spoke about it. That if he died, I would suffer financial loss. So I insured him for 10 baht, that if he died, at least I wouldn't suffer as much. And vice versa. I'm not doing buy and sell with the guy. I don't want to buy the shares. She says, but you have to. I don't have to. The buy and sell agreement compels me to use the money to purchase the share. But in the absence of the buy and sell agreement, it's just my money. I just get paid 10 million bucks. What's nice is I go to Dave's wife and I say, but don't worry, you can still keep the 50% share in the company. You're quite a lucky chick. And then I go and rent property next door and I buy some furniture. I've got some starting capital, I've got 10 baht, put 500,000 into the new business, and I start moving people over, new clients, new business. And she says, hey, what's going on? And I go, no. He's still 50-50. But Dave's dead, you're 50-50 this business. This business is slightly different. This is for new business going forward. And I start building up a brand new business off that base, and she ends up getting 50% of Kwana. Added to that, as a shareholder, Dave's wife is a shareholder now. What is she entitled to? If you're a shareholder of a company, what are you entitled to? You're entitled to a dividend. You with me? A share of profits. Okay? So a share of profit would mean the revenue that you've earned, less expenses is a share of profit, and then we divide it by 2. So the company earned 10 million for the year. The expenses were 5 million. There's 5 million left over. We pay 20% dividends tax of 1 million. We're left with 4 baht. She gets 2, I get 2. Year 1. Year 2 comes. Revenues dropped a bit in this business, but it's amazing how it's grown here. I just can't believe it. But by the way, Dave's wife, I'm doing all the work in this business. And I need a salary increase. So suddenly, the 10 million is now 8 million because of the loss of revenue. The expenses have gone from 5 million to 7 million because I've taken a big bonus and a salary increase. And now we're sitting with 1 million rands worth of profits left. We pay 20% dividends tax, and there's only 80 left for distribution, 800. She gets 400,000, I get 400,000. She goes, I hold the votes. No. It doesn't work like that. I go, well, then, you don't like it, you come and do the job. She says, but I can't. I don't know the business. I go, then shut your face. And I'll just keep building this business over here. It causes such bad behavior. If you have a policy that someone owns on your life with no mindset agreement, get that policy cancelled. It is more detrimental to you to have that policy on your life in the absence of the buy and sell agreement than it is beneficial. What makes this whole transaction worse, guys, is when I get the 10 million rand paid by the insurer to not do the buy and sell, his estate is liable for 20% estate duty on that policy. They lose 2 million rand because I got 10 million. How counterintuitive is that? So guys, if you don't have an agreement, you don't have buy and sell. You have a flippin' big estate duty problem. That's what you've got. Okay. Be careful of these definitions here as well. What benefits are on the policies? Death and disability. The disability definitions, they vary, guys. There are all sorts of products in the market. I don't like to name drop and slate other companies, but we've made a couple of discoveries in the past, just not taking any liberties, by the way, but just the disability definitions change from insurer to insurer. We use what they call own occupational disability. The acronym OOD. Okay? It means if I can't do my exact job, I get paid out because I'm disabled. If you go to other insurers with different colors, like blue and brown, as an example, they sometimes have what they call occupational disability, which sounds pretty much similar, except it says in the fine print, if you can't do your job, okay, they will pay. But if you can do a job that is similar or reasonable, or a job that you could do by your training or ability, they will not pay. So I'm the MD of the business. I get disabled. Can I be the 2RC? Or can I be the receptionist? Or can you do something similar or something reasonable? And if I can, they don't have to pay. So it's very important to understand your job earns as a GP 800,000 Rand a year. As a specialist, it's 8 million Rand a year. Imagine a specialist who can't do his job anymore. Let's say he's a cardiac thoracic surgeon and he can't perform surgery anymore. Can he lecture? Yes. Is that similar? Yeah. Is it reasonable? Yeah. Okay, we're not that. Can you be a GP? Yeah. Is it reasonable? Yeah. Is it similar? Yeah. Well, go be a GP. We're not going to pay. But the cardiac thoracic surgeon is going to go from 8 million a year to 800,000. Don't give a rat's. Just fits into the definitions. So please watch those definitions. If every occupation has got a different hazard. Just think of you and your job right now. If you get arthritis in your hands, just arthritis, can you still do your job? Then can you do your job? You've got arthritis. Can you do your job? You can't type now anyway. Think about it. If you get arthritis, can you do your job? Honestly. You can't. Yeah? Can anyone do their job with arthritis? I can. I can do what I'm doing now with arthritis. I won't get paid. But if I'm a cardiac thoracic surgeon and I've got arthritis, I can't do my job. So sometimes the condition is a non-claim event in some occupations, yet a claim event in others. Okay. That's why we need a deep understanding as to what you do in your job to make sure you've got the correct cover in place. So when a claim arises, you get paid. Terminal illness, another one. If you are diagnosed to be terminally ill, you're not dead, you're dying. The doctor said, sorry, Bob, you've got 8 months to live. You are deemed to be, in the insurance eyes, terminally ill. The insurer will advance all your life cover to you right now. They'll pay it to you now before you die. So you can sort out all your affairs before death. Amazing. But if it's not mentioned in the buy and sell agreement, you've got a problem. You get diagnosed terminally ill, and the agreement says, when you die, I'll buy, and if you get disabled, I'll buy. What if you get terminally ill? All that happens is the insurer will pay me the 10 million bucks again, and I've got no compulsion to buy the shares because he's not dead yet. And he's not disabled either. He's just dying. And you actually are all dying. You should be ashamed. He was terminally ill as well, remember? It was terrible. He also had like a year to live, about 15 years ago. Awful. Preemptive rights we've spoken about, repudiations of claims. Let's say your partner lied on the application form. Have you had cancer before? No. Tick. Meantime, he did 3 years ago, but lied. Now you come, the guy dies of cancer or anything else, and the insurer says, I'm sorry, we're not paying. He actually lied. He did have cancer and told us he didn't. We never had the opportunity to rate him or decline him or accept him because he lied. So we're not paying. But now the buy and sell says, he's dead, you must pay. What happens? The buy and sell is a binding contract. The fact that the policy hasn't paid is your problem. So you need to contemplate how that's drafted into your buy and sell agreement. Exploration of risk benefits. Your disability cover expires when you're 65. What if you're still in business and you're 67 and you get disabled? There's no disability benefit anymore. What happens? And then also the big thing, if you're in business with a trust, your trust owns a company, or your partner's trust owns a company, or your partner's trust's company owns a company, or your partner is another company. So that is a lot more complex. We do it every day. It's easy for us, but a lot more complex to explain at a meeting like this. But we'll go through that with anyone who needs any help there. All right. So the results of no buy and sell agreement in place, not policy, agreement in place. The surviving partner can trade the business down to nothing and open up next door. No third party will purchase. Dane's not going to buy because of George's hostility. Your family gets less than actual value. Instead of getting 1.5 million, she's going to get 100 grand. Your competitor becomes your new business partner. Dane's business that's 10 times bigger or 10 times smaller has now got all George's IP, clients, financials, everything he needs to compete against them. Your ex-partner's wife or children become your new partner. Dave's wife becomes my new business partner. She only gets dividends. She doesn't get a salary. I get dividends, I get salary, and I get bonus. So I just rape the business and leave her with hardly anything because she actually adds no value to my business. And your ex-partner's trustees might become your new partners as well. So a lot to contemplate, but very important to understand. All right, I want to do a quick leg stretch. I've got a small little hamper over here, which I would like to give away. We're going to play a game of heads or tails. I'd like you to stand, put your hands on either your head or your bum. I'm going to flick a coin. If you're wrong, you're going to sit. Heads or tails? Okay, ready? We have a head or tail sit, please. You can change your position if you want to. Heads or tails? Wait, blind. I have a tail. All heads sit, please. 81. Hey, you check that out. That was probably one of the shortest heads or tails. It's normally about 4 rounds. Well done. There we go. Thank you. Yeah. All right, now we're going to do Zumba. Okay, who knows that? No, I'm joking. All right, next one is sureties. How many business people have to borrow money from a financial institution? You buy a building, you form a company, you buy a building, you take a bond on the building, the commercial property or industrial property. Or you need to just buy a house, sign a surety. Or your business needs some equipment. You finance it. It needs a machine, printing machine. You're a radiologist and you need radiology equipment and you borrow money. An overdraft facility. The banks lend you money when you sign a surety document. They ask for your income, your assets, your liabilities. They want to know all about you and your business. You submit that to the bank and then they give you a pile of documents about that thick sometimes. And you've got to fill out all these forms. And if you fill them out correctly, they'll lend your business some money. Most people enter the bank on their hands and knees and will literally sign anything. In your surety documents, there are some things to contemplate. Firstly, they are recoverable from your estate. So just to understand that, when you sign a surety, a personal surety, what it means is you have borrowed money from the bank, but you have used your personal assets as security against that loan. Okay, so the bank surety is normally joint and several. Just to explain what that means. George and I have borrowed 10 million to buy a building. We've signed a joint and several surety. It means that we are both joined to that full debt in full. Okay? We're both liable for the 10 bar. We've only borrowed 10, but we've given them security for 20. He's given 10 and I've given 10. They also use words like co-principal debtor, which means that the business has borrowed the money, but we also are co-principal debtors. We also owe the money. So now they've got the company owing 10 bar, plus George owing 10 bar, plus me owing 10 bar, for 10 million rands worth of loan, 30 million. You with me? Then they have another thing called the excussion clause. I don't know if you've ever heard of that before. It's written in Latin on purpose. So what they do there is they waive it. They waive the excussion clause. So you think, thank you. Finally, they've waived something. What that means by waiving the excussion clause is that when there's default or a change in risk, the bank don't have to follow the normal business route of debt redemption. In other words, they don't have to go to the company first to get the money. They go wherever they want to get the money quickest. All right? We saw this play out heavily during COVID. People think that the bank only come take their money when you die. During COVID, one of my best friends had a 6 million rand overdraft facility. And Absa Bank wrote to him to say to him, in light of COVID and the risks your business poses, we are reducing your facility to 4 million with immediate effect. Please put in 2 million rand. He was not trading. He had no money, and his facility went from 6 to 4. 2 months later, they said to him, because of the economic environment and COVID in your business, we are reducing your facility by 500,000 rand per month, every month, with immediate effect. The bank can take the money that you've borrowed whenever they want to, whenever there's a perceived change in risk. So we need to understand that first and accept that. Okay? The next thing is when you die, your executor who takes your position, before he can pay any money out to your children, your wife, transfer the house, do anything, the first thing he has to do is write to every single financial institution and settle all your liabilities. Pay all the state duty, all the capital gains tax, all the executors' fees, master's fees, funeral costs, and make all sureties redundant. He needs to write to the banks and ask them to please release the estate from the sureties before he can do anything. So to understand that, George and I own a business together. It's worth 20 million, 10 million, 10 million. We borrowed 5 million. We do a buy and sell agreement. He dies, the buy and sell is perfect. I pay the 10 million across to his estate. His wife, Jules, she gets the 10 million rand. In her estate, she's got 10 million bucks. Woo-hoo! She's about to spend it until the executor says, we've got a bond here, or we've got a surety here. Standard Bank. They want 5 bar. Standard Bank goes straight to Jules, takes the 5 million out of his account, because they can, because he signed to the effect that they can, settles the debt for the company. Now I have got a debt-free business. My loan of 5 million has just been squashed from his 5 million. Jules is left with 5 million rand, not 10. And I bought a business for 10 and actually got 5 million extra for free. His estate has not got a surety against me. I've signed nothing with his estate. So he can't come claim the 5 million from me. He can try claim it from the business if he wants to. But then the business needs to try and find the money. And sorry, but we're really battling at the moment. You know, George is dead and he was the business. And as a result of this, we just can't raise that kind of money. So for 3 or 4 years, she could be sitting trying to pursue me to claim the money back that had settled that loan. And she might not be successful. There's no guarantee of it. So in the absence of this suretyship protection, your estate will pay the money. A lot of business owners come to us and say, I understand that, but I'm not covering the debt. Guys, understand, if you've signed a surety, you have covered the debt. All you've covered the debt with is your family home, your ski boat, your car, and whatever proceeds come from your buy and sell. You've covered it. All we're doing is we're changing it. You say, listen, leave the guy's estate alone. Protect his estate, because all that money in your estate is after tax money. That 5 million rand that is in George's estate, he'd have to earn 7.5, 8 million rand to net 5 million. It's 5 million net. It's after tax money. It's going out to pay a third-party debt. Plus, as soon as that 5 million leaves his estate and goes to a third party, what does SARS do? Oh, what my estate duty is? Where's my 20%? So all of a sudden, he's paying another 1.25 million rand in estate duty on top of the 5 million to settle my business debt for free. This is probably one of the biggest holes that people don't understand about their businesses, is covering sureties. All right. I don't want to cover the liability done. The assumption that contingent stops at the sale of your business interest. Guys, if you sell your company, you'll see in nearly every sale agreement, it reads, so George is voluntarily selling his business because he's retiring now, and I'm voluntarily buying. It says that the purchaser shall endeavor to release George from his sureties. The word endeavor means, hi, Martin, are you the manager of Standard Bank? Yes. Listen, just a quick one. I bought George's shares in the business. I'd like to know that 5 million surety. Can you please release him? No. All right, thank you. I've endeavored. The answer was just no. Okay. He gets paid his money when he retires. He's sitting on his yacht in Maui, and all of a sudden he gets a phone call. Hi, listen, that business that you sold, yeah, well, Gary buggered it up. And by the way, we need 5 bob because you're still surety. You've got to make sure that your sale agreement says that it is a suspensive condition. The sale can't go through until my surety has been released. We had a guy that we employed who had signed surety for a business for 13 million rand that he wasn't even a shareholder in. He just signed surety in the hope, as a friend, that they could succeed in their business. And over the years, they increased the facility. But the surety that he had signed was an unlimited surety, so they didn't need to review the surety with the guy who had signed. The guys borrowed maybe 500 grand when they started. Then it was 1 million, then 5 million, 13 bars worth of surety. Suddenly, I'm gone. This is the bank here. We've got a problem. So please be very careful of sureties. If you've had multiple businesses and multiple sureties, what I would do is write to every financial institution you've dealt with and say to them, give me a list of all my sureties and give me a letter cancelling them all. Another thing to do with sureties is limit them. Let's just, as an example, say Dave, George, Dane, and Gary are in business together. We are equal shareholders, 25% shareholders. And we have borrowed 10 million rand to buy a building that's worth 20 million. We put in our loans and everything else. We've got this building with a 10 million bond. We've signed joint and several surety as co-principal debtors. What it means is that we don't know who's going to die first. Okay? We don't know. What we do know is that one of us is going to die first. The person who dies first is going to be the one that's going to be settling that debt. It's not really fair. But what we have to do as advisors is say, Dave, you need 10 million on your life. George, you need 10 on yours. Dave, you need 10 million on yours. And I need 10 million on mine. Just in case whoever else dies, we've got over 40 million rands worth of life cover covering a 10 million rand loan. You'll find the premium will probably be the same as a flipping bond payment. I mean, it's retarded. But that's what you've signed for, guys. That's the risk you've got. But we can change it. We can go to the bank and say, listen, there's 50% worth of equity in this business. I want you to limit the surety. George, you only have to sign for 2.5 million of the 10 because you're 25% shareholder. And the same for Dave, myself, and for Dane. We limit our sureties. Now we're only signing for the 2.5 bar, not the full 10. Okay, so that's a negotiation you've got to have. Some banks will, some banks won't. If your bank won't negotiate, find another bank that will. And threaten them and say, guys, if you don't do it, we're moving our business. Who pays the premium? The business does. It's a business debt. You don't pay the premium. The business pays the premium. The business owns the policy on your life, and the business is the beneficiary. When you die, that money goes into the company to settle the company's debt. Easy peasy. And then your estate is secure and protected. The surety is waived because the debt that you've signed for has been settled. Your family can keep all their assets and they can continue with their plan. But in the absence of this, you've got a problem. But guys, just remember, the last point is the most important. An agreement is drafted. Contingent liability is not a policy. the policy funds it. A contingent liability agreement, the same. When the policy pays, the company must use the money to settle that liability or portion of the liability to release the estate from its surety obligation. If you don't have the agreement in place, all that happens is Dane dies, the company gets 2.5 million rand or 10 million, whatever he signed for, and we go, hey, let's take our loan accounts out, or hey, let's declare a dividend, or let's have bonuses. There's no compulsion for the company to use the money to release the estate of its surety obligation. So his estate still gets nailed. And we just got to like a big check in our bank account and we can do whatever we want with it. You have to have the agreement in place. The number of people we've seen who have taken a policy without an agreement is frightening and so stupid. But the problem is, most of the policy peddlers out there, the corner brokers, don't understand law, don't understand accounting, don't understand business. All they want to do is sell a policy and earn commission. Because once you've bought, they've been paid, they're gone. They leave all the other nitty-gritty up to you to sort out as the business owner, but you're too busy being in business to sit and worry about this, or you don't even know about it because they haven't told you. You need a specialist to hold your hand. I love listening to things like stories about like Richard Branson. He suffered from dyslexia, or still does, suffers from dyslexia. He's not the brightest man in the room, but he's a great ideas man. When he goes into a business meeting and he meets you for the first time, and he says, listen, let's talk about your business. What's your idea? And the guy pitches. Richard gets a gut feel for the guy, whether he likes him, if there's integrity, and he has a feel for what this concept is. And he says, you know what? Fantastic idea. We're going to do business. But next to him, he's armed with accountants and attorneys. Let my people talk to your people and sort this stuff out. Why aren't we doing that, guys? Why do you go and conclude deals like you, Richard Branson, on your own when you're ill-equipped? That is what Quattro does for you. You can literally have in-house counsel at your disposal when you're a client of Quattro's. You've got a team of attorneys and a team of CAs sitting next to you, helping you make strategic business decisions and protecting you and your business from all of these perils that we're talking about. And you don't pay us a salary because the insurer pays us a commission if we sell a policy. And if it's an agreement, you'll pay for the agreement. And if it's accounting services you need, you'll pay for a review. But you're not paying 100 grand salary for an accountant and 100 grand salary for a lawyer just in case something comes up. It's ad hoc. I need you. Come quickly. This is the project. What will it cost? 60 grand. Cool. Let's do it. 50 grand, whatever it might be. But you've got a team that have got your best interest at heart. Remember, the more money you make, the more money we make. If Len goes and makes 10 million rand this year, I'm going to be knocking on his door saying, Len, listen, Foundation Fund Managers does stockbroking internationally. I want you to come buy some Apple shares. So it's a win-win situation. It's an ecosystem that works. The better we are for you, the better you'll be. The better you'll be, the better we are off. All right, so your personal state, I mean, I've spoken about this, but if you don't have an agreement, your personal assets will be sold off, not might be, will be sold off to raise the money to pay for your company's debt. And we know this because one of our companies is called Quattro Wills and Estates. So we actually do this. So don't be a statistic. You can fix it. It's easy. All right. The last risk cover I'm going to go through just very quickly is if you have anyone in your business who is key. In other words, this business literally is dependent on this person being able to be alive and not be disabled. You can actually insure that person. And you insure the person for the company's losses that it will incur should that person die. I'll give you an example. Late last year, one of our business partners passed away from COVID and left a big hole in our business. We didn't have key man cover on his life. We didn't realize the role that he actually fulfilled on a daily basis. We knew he was important, but we kind of had a perception that what he did, we would just step into his shoes and do. But suddenly we had to do all the administration. The burden it placed on the other partners trying to get this business back on its feat, and Dave was one of the pivotal people in getting the business back up and running and getting all the systems and plants and stuff sorted out. But it was a massive drain on the business, and the business suffered massive financial loss. If we'd insured him, the company would have got the money to afford the financial loss and had the resources to be able to deploy other people and resources into the business to either recruit new people, train new people, but survive the financial loss. So when you're in business, really look at your business associates and your shareholders. And sometimes it's not a business partner. It might be an employee that is really, 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 really key in that business. If that employee falls over, you're going to have a wobble. It might be for 1 month, it might be for 5 years. I don't know how pivotal it is. But if you need to ensure that person's or the company's ability to sustain itself, cover them. Because remember, as a business owner, you've got a new responsibility. When you got married, you had a responsibility of a spouse. When you had children, you had a responsibility of children. When you have a business, you've got a responsibility of those families that you employ, all those employees and all of their family members. They need a salary at the end of the month. They need to know that they will survive, that this business will still continue. It's so important that you contemplate key man cover. But not all businesses have key people. Okay, just some do. The last thing, this is the final one, is just designing an exit strategy. So I'm ending with where we began. The first thing you do when you start your business is think about how you're going to exit. George is one of the top financial planners in the country. Sits with you as a client and he says, listen, I'm doing your financial plan. Tell me about your retirement. And you say to him, George, when I retire, I need 80 grand a month income, minimum. I want 150, but I need 80 grand, guaranteed. So cool. George will put the 80 grand in. What age do you want to retire? I want to retire at 65. Cool. How old's your granddad? When did he die? How old's your granny? Or when did she die? Brothers and sisters, siblings. Try and get some family history. What is your life expectancy? What do you think it's going to be? 90. Great. So I've got to make provision for 25 years worth of income of 80 grand a month in today's money, increasing every year at 7%. How much money do we need? He does that calculation for you. He says, right, we need X amount of money for you to do this. Let's look at all your income streams and all your income opportunities. Let's look at all the cash you're going to have saved up, and let's do this exercise. He'll take your retirement annuities, your pension fund, your discretionary savings, all of that into account. He'll take the fact that you're selling your 20 million rand house and you're buying a 3 million rand apartment if you want to. We do all of that. Puts it all into the plan. And then he says, you're a business owner. Yes, I am. What are you doing with your business when I retire? No, I'm selling my business. All right. What's the company worth? It's worth 10 million bucks today. Fantastic. What is the growth rate that you're going to get on your business every year, year on year, until you retire? Realistically. The guy says, our business grows at 10% a year. Okay, how many years? 3. Well, it's not really a good benchmark. So let's be realistic. Will your business be able to grow 10% a year every year, continually for the next, let's say the guy's 40, the next 25 years? No. Okay, what? Let's be conservative. 8%, 7%, whatever it might be. George sticks it into the plan. So now we know we're going to sell this business. Who is going to buy your business? Because the business is going to be worth X amount of money. Okay? Who's buying it? Because remember, the person who's buying it needs cash. So my business partner will buy it. All right, cool. How old's your business partner? No, he's 4 years older than me. Well, then it's not really going to work very well, George, because you're probably going to have to buy him out because he's older than you. So you've got to contemplate that. How old is your business partner? Is he younger or older? Okay, if you're the younger one, start saving. If you're the older one, start planning. But you need to find that strategy because we need to know who the buyer is. We need to know, can that buyer afford it? Is it going to be that your business is too big for an individual to buy, too small for a corporate to buy, or is there a competitor that's going to buy? But we need to identify the buyer. We need to identify the growth of the business, to identify the value. But too many people just put in, our business is worth 10 million, it's going to grow 10% a year, when retirement is 7. And they base their retirement plan on that. When they get to retirement age and realize their business is not saleable, they can't find a buyer, and now they're stuck. The whole retirement plan is gone for a ball of chalk. So we need to design a strategy, and this we do with you one-on-one. If your business is built around you as an individual, and you don't change it, you are doomed. Just understand this. My doctor can't sell me when he retires. He might get another doctor to come in, but if I don't like that doctor or trust that doctor, I'm going to move. My dentist can't do the same. We've got an arrangement, my dentist and I. You hurt me in the chair, I'm going to hurt you in the parking lot. It's like we've got common ground that we've like kind of set in stone there. But my dentist can't just buy me. Sell me, sorry, can't just sell me. But he could if there's a strategy in place. So what's the strategy? So I'm the dentist or the doctor, just as an example. And the same would apply to an architect. My architect, I love him because he draws pictures that I enjoy. But when he stops, I'm going to find another architect. So what happens is that if my practice is one where it's based on me, we need a strategy. So what happens is I'm the dentist, I'm doing my stuff, and you come in, and Dane is going to be my succession plan. And he comes in 3 years before I leave. So I'm in the chair, let's say the dentist is busy there, and then suddenly I've got this new face coming up, Dane. He goes, hi, this is Dane. I work with Dane. Hey, great. Dane, just do a little like cleanup here, because I don't like working on dirty teeth. So Dane does the cleanup. And then the dentist will come back again and he'll do a couple of little injections in my tooth. And then he'll say, oh, Dane, can you just pull that quickly? I'm just doing this here. So Dane will like do little bits and pieces. The next year I come back for my review. I'll see Dane first. Dane will say, hey, let's just go do the x-rays, check how these fillings are working, and everything's still cool, no cavities, yes, and everything's fine. Great, go in the chair. Then the dentist will pop in and go, hey, Gary, how are you doing? Long time no see, fantastic. I see you in good hands here. Dane's doing a wonderful job. Dane, I'm going to quickly do the cleanup for you, and then I just want you to put the injections in. So the dentist does the clean, and Dane does the injection. He's now passing the relationship and the trust over onto Dane. And in the 3rd year, I don't see the dentist, I see Dane. So some businesses can be evolved. Some businesses are just really saleable. With our business intelligence tools we're able to put a system in place where you can digitize your whole business, pull data from all different sources, and not just give you the word BI is bandied around like Smarties. BI is not BI. BI is a load of bombs. I'm talking about proper business intelligence, where it gives you information that is actually informative in your business, that allows the business owner to be able to see on a dashboard exactly where his business is in terms of stock, stock on order, manufacturing, what the machine efficiency is like, the time and attendance, sales. You can see it as live data. It allows the business owner to take that and sell that to somebody else very easily, because it's easy for someone to be able to interpret. To get a set of financials and try and make a financial decision on buying a business with a balance sheet and income statement is hard, because it doesn't give you any info. It gives you information, but it doesn't give you any insight. BI gives you insight. It actually gives you a proper, deep understanding of the business and where the opportunities lie for growth in the future and where weaknesses are in the business. When you're selling your business, the BI, the 415 that we put in place, builds ratios and says to you, your business is fantastic. Sales are up. You're doing wonderfully well. Profits are up, but you've got a cash flow problem. Your business is only worth 30 bob. Why is there a cash flow problem? No, you discount factor in your book. If you don't do the discount factoring, if you put 5 million rand in cash in and do over the discount factoring, that 5 million is going to generate you an extra 3.5 million rand profit a year. And your multiple of your business is a 7. I can take your company from a 30 million rand value to a 57 million rand value just by one little thing. Your financials aren't going to show you that, but the BI does. So if you're wanting to look at exit, guys, contemplate it now. Put systems systems in place to make your business something that is going to be something saleable in the future. Because remember, if you're not doing it, your competitors are. So you're doomed if you don't. So the last thing is just with your business. When you sell your business, again, the sale agreement is crucial. I alluded to it earlier around just the surety as an example. How are you going to be selling this thing? Make sure the agreement protects you as a seller. Is it an installment sale? Remember how capital gains tax works with SARS. Capital gains tax is due at the end of the year, end of the financial year, of that signature. So I'll give you an example. George is buying my business for 10 million, but he's going to pay me R1 million a year for 10 years. That's a simple example. The sale agreement is drawn up. It says 10 million, 1 million a year. We sign it. On year one, he pays me the $1 million. I have to pay capital gains tax immediately on the full 10 million. And I only received one. The capital gain that I made on the business, I started it at 0 and it grew to 10. My base cost was 0. So I made a 10 million gain. I take 40% of my gain, which is called an inclusion rate. So it's 4 million rand, takes at 45%, which is my marginal rate of tax. So just to thumb suck it, let's call it 1.8 million rand tax I've got to pay. I've got to pay 1.8 million rand in capital gains tax in year one, and he's only paid me $1 million of the purchase price. So I'm still negative 800,000. And then in year two, he pulls out of the deal because he's buggered the business up. Now I've got to step back in the business. It's now worth less because he's buggered it up. And I'm still minus 800,000. I can't get my capital gains tax. I went to SARS going, oh, sorry, the OD faulted. Can you refund me? And she's like, what about? So make sure that your exit strategy is really planned.